Hi, this is Chris German from The Apartment Dealer, and today I'll be bringing you our 2019 first quarter multifamily update. What we will be taking a look at is where were things this first quarter of 2019 versus the first quarter of 2018, and can that tell us anything about market direction, whether that be up, down, sideways. Now, the information itself is very specific to the geographical locations that myself and my team work. We do sell properties in two counties now, both Los Angeles and San Bernardino County. But more specifically, we'll be taking a look at the data from the 710 freeway, as far east as the 215 freeway, as far north as the 210, and then as far south as the 105. You're receiving this market update because you own at least one property within that geographical location. To start, let's take a look at total transactions. Now, this will be the total number of multifamily properties that sold beginning with the first quarter of 2018, those buildings that are 5 units or larger, and then we'll take a look at where we were in the first quarter of 2019. So in the first quarter of 2018, Los Angeles County, there were 50 total transactions. In the first quarter of 2019, there was 55. So there was a 10% pullback. But I don't know that it tells us that, hey, for some reason there was a big shift in the marketplace. I think it's more telling that there was just less supply. Buyer sentiment, seller sentiment seems to be very similar to that of what we saw last year. And even amidst a marketplace today with rent control breathing down the necks of landlords in various cities that now have rent freezes, and the state at large with assemblymen and women contemplating rent control, even amidst the fact that the citizens of this state voted down Prop 10 last year. And that at least is telling that things are at least trailing sideways, if you will, here within Los Angeles County. Now turning to San Bernardino County, again, very specific to that corridor, say between the 57 freeway and the 215. The total transactions in the first quarter of 2018 was a total of 9. Now, that's about average for the Inland Empire, even when things are going gangbusters. So again, it's just reflective of how many transactions typically will change hands in the Inland Empire. It is at a slower pace compared to Los Angeles County. But 9 transactions 2018, first quarter of this year, 6. Now that's a 30% drop off. And if this was the only data point we were looking at, one could extrapolate from that there must be a big change in the marketplace. It's not so. Buyer sentiment is probably higher than we've ever seen for the Inland Empire. You see buildings, even in this first quarter, trading hands at record-breaking prices. Myself and my partner, Deepan Shah, recently sold an apartment building in the city of Ontario. That broke the highest price point ever sold in the city's entire history. So you see things happening like that in this first quarter. So again, I think this was more telling of just a supply issue and not respective to less buyer demand in the Inland Empire. Now, with respect to cap rates, for a quick review on cap rate, if you were to buy a building all cash, what would be your expected rate of return on your money? In Los Angeles County, in the first quarter of 2018, the cap rates were at 4%. No surprise there. If you've been following the market at all for the last few years and reading any type of trade publications, you know it's been about a 4% cap rate market. And if anything, in the first quarter of 2019, we saw things on average at 3.9. Again, keeping in mind this is reflective of those cities between the 710 freeway and the 57 freeway, as far north as the 210, and then as far south as the 105. So pricing about the same as we saw last year. In the Inland Empire, San Bernardino County, cap rate 4.8%, first quarter of 2018, first quarter of 2019, 4.4%. So this is respective to what I mentioned earlier about pricing, us having sold that property in Ontario for the highest price per unit and other buildings selling at historical values that it has pushed the cap rates lower. That is reflective of the fact that there's greater buyer demand in the Inland Empire than we've ever seen. And why is that so? For those individuals who track the Inland Empire, vacancy is at historic lows. Rents have gained by exponential numbers. And the overall job picture for those living within the Inland Empire is as strong as it can be. Many companies have moved into the Inland Empire. More jobs equals more wages. You have people that have been pushed out of LA County towards San Bernardino County because of the affordability. And the long and the short of it is that's a win-win for landlords who own within this area. Now, transitioning to interest rates. Interest rates affect you as a landlord, it affects your bottom line, it affects your true cash-on-cash return. In the first quarter of 2018, we were at about a 4.5% interest rate with respect to commercial loans. Now, most people, myself included, would have assumed by 2019, we would have seen a significant uptick in interest rates, especially because over the course of last year, the federal government made good on the fact that they would raise interest rates 3 to 4 times. But then come the beginning of this year, they've now decided that they're going to hold interest rates. So now we see interest rates within Los Angeles County at 4.25%. One has to ask, and I learned this from my friend Bruce Norris. If you're familiar with the name Bruce Norris, he's probably one of the most respected individuals when it comes to market forecasting in real estate here locally in Southern California. His question is simply this: what does the federal government see in the economic markets that it cannot raise interest rates? Because most people agree they should be. If we have a healthy economy, if unemployment is as low as they report it to be, wages and everything else, why do we have to pull interest rates back? President Trump, about a week or two ago, actually was calling for quantitative easing. If the market is doing so well, if the economy is doing so well, why is the president calling for quantitative easing? And I'm not pointing to a political point of view one way or the other. I'm just saying in terms of economics, this is something we need to be aware of. But at the end of the day, if you have to refinance a property because your loan has come due, the fixed period is over, you're actively seeking to purchase a new building, you win because interest rates are 0.25% less than they were this time last year. And on sizable loans, that amounts to thousands of dollars in potential savings. The interest rate for the Inland Empire has come down as well. So in 2018, it was 4.7%. The first quarter of this year, 4.5%. So all things indicate that we should have a healthy market. Market is healthy today. We have rents that have never been higher. We have vacancy rates that have never been lower. We have a federal government that pledges to keep interest rates low to moderate. And that all is fuel to what has been a sideways trending market to continue on its own path. Will we see values have some significant uptick? Most people agree that we've pushed rents as about as high as we can. Statistics are that tenants on average are spending anywhere between 35 to 50% of their discretionary income towards rent. Will they spend 60%? So again, that's something that's yet to be seen. But I think at worst, we'll have a market that was very similar to 2018 if the data continues to show. Rent control and other things that are putting pressure on the market, we'll see what comes to pass there. But as of today, as of this Easter weekend, we can claim that the market is very similar to last year. The one thing that's very obvious is that there's more properties that are being sold that come along with private seller financing. For those who may not be familiar with, in a sale where the seller offers private financing, you as the buyer, as opposed to going to Chase or Wells Fargo or some other financial institution, the seller actually carries back the private note for you. And there's many components of that. That's a win-win situation for the seller and a win-win for the buyer. And as opposed to me go through it here now, I want to share with you recorded footage from our apartment owners educational luncheon that just took place in March. You've probably seen our advertisements for this event, but this is a venue where twice a year we bring together some of the most brilliant minds when it comes to multifamily real estate, whether that be real estate law, real estate taxes, market forecasting, both in real estate and capital markets. We bundle it all together in a short afternoon to give you, the landlords, an update so that you can be prepared for the following 12 months. So let's go to that footage now. So, Mr. and Mrs. Smith, we've helped them increase the value of their properties by understanding what capital improvement means. Over time, they've continued to do 1031 exchanges and they've grown, but now they're at a point in their investment life where that's it. They don't want any more tenants. They don't want any more headaches. They're actually looking for a way to exit the game, except there's this kind gentleman named Uncle Sam who, if they sell, would gladly take 35, 40, 45% of their equity. So they hold. Even though they have to grit their teeth and they get bothered when they're on vacation from the tenants, they hold because, rightfully so, they don't want to give away that much of their equity in taxes. So what option do they have? Now, you could exchange and buy a triple net, and I'm sure some realtors have tried to peddle you on that idea, buy a Dollar Tree in Timbuktu. And not that there's anything wrong with those, but is there an in-between? Instead of me holding, because what they're looking to do is they want to avoid the capital gains tax. They would still like a monthly income, and they want to get away from the management. Well, the in-between is if they were to sell and carry back the financing. Now, for some of you, this may be new, so let's talk about a seller finance deal. Let's say you own a property and it's worth $1 million. You sell, and the buyer puts 30% down, $300,000 in cash to you at the close of escrow. The remainder, $700,000, you take back in the form of a note. You now become bank of, and insert your name. And the buyer makes monthly interest-only payments to you. Based on today's rate, that would be somewhere between 4 to 7% return. What does that accomplish? You no longer have any management headaches. You still have monthly income, which many times can duplicate the same income that you're collecting from your building, believe it or not, and we'd be happy to analyze that with you. And you've avoided, for a time, the majority of the capital gains that's to be paid. Because you only pay taxes as principals received, so you would pay taxes on that initial down payment, and then when you receive the final payment, the balloon payment, which may be 3, 5, 10, 15 years down the road, it's your choice as the seller, it's something that's negotiable, you pay your final taxes. Now this Mr. and Mrs. Becker, Mr. Becker had a heart attack. I had sold him a building when I first met him, and he owned a few buildings after that. But then he has a heart attack. His wife wasn't involved in the business. So it was a wake-up call in the sense that he said, hey, if I go down, all this will fall upon Ann's shoulders, and Ann isn't prepared to manage, but I want her to have income. I don't want her to have tenant headaches. And should he be debilitated by a stroke or something else and he can't manage, he wants just the income for himself. So we sold this property here in West Covina. We sold another one in Covina, both through seller financing. More recently, we had the Sanchez family. Again, retirees who they like to travel. They've been to all the exotic places around the world, but they still felt tied down to their property. They didn't want to hand their property to outside management. Because the reality of it is, and I have respect for management companies, but they just cannot manage your property with the same pride of ownership that you do. They have too many clients to service, right? So no one will manage quite like you. They'll get close, but not quite like you. And this family did not want to hand their property off to a management company, so they decided to carry back financing. The property was worth $985,000. The buyer put 25% down. That amounted to $246,000. The loan amount was $738,000. They carried at 4.5% interest rate. That equated to $33,000 annual income that they now have in place. If you take a look at over 5 years, because that's the term, in 5 years that loan comes due. So after 5 years, if they earn $33,000 per year, They had the 246 down, they get paid the final balloon payment, it becomes $1,151,000, not the $985,000 had they just sold and cashed out. Now, most recently, I told you that I just sold a property in Ontario for a record-breaking price, $230,000 per unit. That family carried back the financing. And rather than me tell you, I'd rather have them tell you in their words, why did they choose to do so? Because this family, her father built the apartment building. When she handed me after we closed escrow and she handed me the blueprints, there was tears in her eyes because it felt like she was giving a piece of her father and mother away. But it was time to sell for her and her husband, and so they chose to carry financing.
Little by little, they got renters that came in, and most of their renters ended up being like family orientated. They made it like a family orientated apartment where the people lived there for years. What brought us to the decision to finally sell and move on was we felt we're getting older now, and we do not want the responsibility of having to look after them anymore. And then we also had a gentleman by the name of Chris German come around and call on me for about a year and a half and asking me, finally, he called one day and I was kind of caught off guard. And I said, well, I'll tell you what, if you can come and convince my husband to talk to you because you are in the real estate business, and he doesn't have too much to say about the last real estate decision that we made. So if you can come and talk to him and get him to talk to you about it, then it'll be fine. One of the advantages was that we were getting interest on it for 5 years and made the price of the property go up higher than what we sold it for.
Because of the opportunity to the buyer. It was easier for the buyer to take over and set up the financing was all us. We were like the bank, and we liked the interest rate per month. And there was other options we were offered on that, but we chose one that we wanted to do. But if somebody was thinking about selling and don't need the finances, sent to you all at one time, and you can make X amount of dollars per month, more than you're actually making if it was sitting in the bank, it'd be a smart way to go. Because you look at this and the net is almost the same as we had if we owned them, and we have no headaches. I still, and that's a good way to look at it. And I'd recommend this to anybody that wanted to contact us or anything. They were handled very professionally, and that's what I made my decision with.
Now, what Mr. Inman doesn't mention there and why he had such a big smile is because that property, given seller financing, sold $250,000 over the list price. 15 offers later, this was just the beginning of March. 15 offers later, and we put it through a bid process, a little proprietary thing that we do when we're selling a property. And after that bid was done, the end buyer, and I can say it like this because that buyer's not in the room, but they paid $250,000 over list price, and I think that made the decision that much easier. Mrs. Inman, because it was her father who built it, could sit at ease that the property did what it was supposed to for her parents and saw them through their life. It saw her through the vast majority of her retirement and will continue to see her forward as long as she continues to carry the financing. Now, I hope that sheds some light on seller finance transactions, the ins and outs, and how they function. If you have more specific questions on what does that mean to your financial situation, the goals and plans you have for your portfolio, please contact our office. Any information that we could offer that would be helpful in the day-to-day management of your properties, that's what we're here to provide. To that point, our next educational luncheon, our apartment owners educational luncheon, will be October of this year. Now, we're not taking any reservations. I know to the disappointment of many of you, you've called in before and unable to reserve a seat because we had full reservations. We will open the reservations closer to September, so just keep an eye out for that and make sure you call in early enough. But the bottom line is the content we're providing, whether it be educational venues like that event or videos like this, we want to ensure we're serving you, the owners. And to that extent, please leave me a comment. Are you finding these videos helpful? The prior content that we've provided. What future content would you like to see? Who could I go out in the marketplace and interview on your behalf? And what questions could I ask them that would help you on the day-to-day management of your property? That's why the apartment dealer is in its existence, to work alongside owners as they continue to build their financial legacy. Until we speak again, Chris German from the Apartment Dealer wishing you positive cash flow, tenants who behave, much protection from Uncle Sam, and on this Easter weekend, I think it's safe to say, and God protect us from rent control. Chris German, have a great weekend and happy Easter to you and your family.